My name is Andrew Swan. I'm very pleased to introduce the Asian equity strategy we recently launched with GSFM. I currently work with the Man Group within a business called GLG, which is their discretionary management business. I am based in Sydney, having moved back from Asia just over a year ago, having spent the last 20 years, in fact, mostly living in Hong Kong and also Singapore over that period. So I've joined Man Group about 2 years ago and now in my 20th year of actually running money under this type of strategy. Firstly, Man Group, for those who aren't familiar with Man Group is a UK listed investment house. It has a number of businesses, 5 in fact, spanning anything from quantitative to discretionary management. The big business that I work in is called GLG, which is the discretionary or fundamental business. And we have a range of global or regional products, anything from long only to also absolute return funds, with assets of about 24 billion compared to the groups of about 130 to 140 billion dollars. In regards to my process, this is effectively what I've been doing now for 20 years in Asian equities. What I've tried to do here with Man Group and in partnership with GSFM is to really take the best of what I've learnt over that period and apply it in a very focused and concentrated manner with a very dedicated team behind the product. There are 3 fundamental or 3 basic foundations to the process. One is it is fundamental. Number 2, we apply a concentrated approach. And number 3, flexible. And I think the last point is quite important. With regards to being fundamental, it really means that we are understanding the companies that we are investing in. We're taking a very much a bottom-up approach when we're picking stocks and doing traditional fundamental analysis to our investments. With regards to being concentrated, we run a portfolio of about 35 companies at any one point in time, between 35 and 40. Slight preference for mid-caps, but that doesn't mean we exclude solely mid-caps. We also are very comfortable in the large cap, and we do have some small cap exposure as well. But I think the point on being flexible is probably the most important one here. And we'll talk a little bit about it afterwards. But over 20 years of delivering consistent returns to clients in a region like Asia, which is extremely volatile, the only way you can do that is by having flexibility around the style that you're comfortable and exposed to, investment style. So in many ways, I call myself style agnostic, but the style exposure, investment style exposure in the fund is actually quite deliberate. So sometimes we are in China, or maybe other times in India. Other times from a sector point of view, we may be in financials or healthcare. And then from an investment style point of view, very comfortable being either in growth or value and other traditional styles. I think you need to have a lot of flexibility around these, I guess we call factors, because factors are heavily influenced by the macro. And Asia, by definition, being an emerging market, mostly is very volatile relative to developed markets. Behind the product, as I said, I have now 20 years of actually running money in Asia, more than 25 years of total experience. Prior to joining Man Group, I was the head of Asia and emerging markets for BlackRock, based in Hong Kong. The business there started with about $1 billion, and we were over $25 billion by the time I left. The fund that I managed directly was a top quartile performer over the life that I was running the fund, and at many points was actually top decile. On this slide, regards to portfolio composition, I think the main point of this is to highlight that we do have a diversified exposure across the portfolio, across the region, whether it be in terms of countries or sectors or style factors. The allocation to these macro factors is deliberate. And there's some examples here in this slide in terms of how we're currently positioned. But the point of this is that it does change through time. We're not beholden to one investment style or one country or one sector that we only invest in. In fact, we take a very diversified approach across the region, and that also changes through time depending on where we're seeing opportunity. The active risk of the strategy sits between 4 and 8. Generally, it sits in the middle of that range with active share above 70%. And as I mentioned earlier, between 35 and 45 names, currently running at the low end of that level. I think it's important to talk about the team. And the reason I want to talk about the team is the way the process works is that 100% of the ideas in the portfolio are analyst-driven ideas. They are accountable for the idea generation. The performance is judged based on not just the attribution in the funds, but also the performance of their ideas individually. They're empowered to find ideas within their universe, and those ideas generally go into the portfolio. And the reason I say generally is because at the end of the day, I have full accountability and discretion on the portfolio, but I 100% back my team in the process. The 6 main people are obviously myself, and then the 5 analysts detailed in this slide. Andrew is based here in Australia with myself, in Sydney in particular. His background is actually from, most recently from a pension fund here in Melbourne. And he covers North Asia, financials, real estate and healthcare. Then we shift to Alethea and Anand. Both of them actually worked for me at BlackRock and joined soon after I did at Man Group. You can see their coverage there. Both of these analysts have covered some of their coverage before when I was working with them at BlackRock. In Alethea's case, Southeast Asia, and in Anand's case, India. But they've also taken on new responsibilities within the group, which I think is an important process, or part of the process in terms of getting fresh perspective and fresh ideas as intelligent, talented people look at old problems with fresh eyes. Sally has come from the sell side and is doing our North Asian consumer and communication space, and Jingjing is helping across the board, the more senior analyst. So this is the team. We were set up pretty much from day one. We see this as, we don't need to expand from where we are. The product range is serviced nicely by this team. It is a very experienced team. It's also a very diverse team, which is important part of my philosophy around what drives success in the industry. This slide is really just a quick snapshot of performance, historic performance. And you can see here from this slide just the consistent excess returns through time, regardless of whether markets were going up or down. And that's really the objective of the fund still today. It is what I've done my whole career, trying to deliver excess returns through the cycle. So to summarise, I've had over 20 years of experience in the industry, 20 years exactly in terms of running portfolios, and consistently throughout that 20 years I haven't had a break doing it. It's effectively the same strategy that I've done or process. It's just that I've tried to build a better mousetrap, I guess, through time. I've now got a very consistent long-term track record of excess returns through numerous investment cycles. We've seen incredible bull markets and bear markets over that period, and always delivering consistent excess returns. It is very much a bottom-up approach with a top-down overlay, very fundamental approach, and we really back our high conviction ideas by having a very concentrated portfolio. So let's go in a little bit more detail around the actual investment process. I think the first slide here is important. It's simple but important, and that is, Asia is a very fundamentally driven market, number one, and number two, it also shows a lot of dispersion inside the market. The chart on the left shows you that the market really tracks earnings. You get a lot more volatility in the short term in terms of the stock market and prices, but at the end of the day, it always tracks earnings. So it is a fundamentally driven market. And the second point is really a case for active investing still in Asia. I think some of the challenges in developed markets is that stock correlations have increased through time. Dispersion is quite low. We haven't had that phenomenon yet in Asia. So we still have very high stock dispersion, which creates the opportunity set, at least, for active investors to deliver excess returns through time. So what is at the heart of what we do? Well, before I go too much into this slide, I think it's important to understand that we are very focused on earnings revisions. It's almost exclusively an earnings revisions focused strategy. And so what is earnings revisions? Why earnings revisions? Well, earnings revisions is really the element of surprise versus in terms of a company's expectations, or company's fundamentals versus market expectations. And so I've built my career, as I said, over 20 years, having a good hit rate on being invested in companies that do better than what the market's expecting, and avoiding companies that do worse than the market is expecting. That's the essence of what I do. The best way to represent that is earnings revisions, which is a quant signal. I'm not a quant manager, to be clear. I am a discretionary fundamental investor, but I've always worked in businesses with quantitative businesses, so I understand the industry. But we are not a quant investor. So what we are trying to do is by being long or being positively, actively exposed to companies in the region that deliver positive earnings surprise, or at least the best relative earnings surprise, depending on where we are in the cycle. And the reason that works so well is really this slide here, and that is the change in the market multiple is highly correlated with earnings revisions. So when you're seeing positive revisions for the market, earnings revisions, you tend to see multiples, PE multiples, expand. And when earnings revisions are negative, you also see PE multiples contract. So what we do is really just focus on earnings revisions, because if the multiple is tracking the earnings revisions, it means the market is really tracking earnings revisions. And this is one of probably the most important but least understood slides in the markets. I think we're fairly unique in what we do, because this is a kind of a quant factor that we're applying a discretionary approach. And the reason we apply a discretionary approach is we are trying to take a forward-looking view on where revisions may lie. Now, a lot of quant funds try to extract this factor from the markets by waiting for revisions to happen. But we actually make forecasts by investing in the companies we have high conviction they will deliver positive revisions in the future. That future can be 3 months, 6 months, 12 months, or 18 months, but nevertheless, it is a future-based forecast on where revisions will lie. The slide here in terms of just looking at some of the research around revisions, highlights the power of it if you can do it well. So on the left on this slide, you'll see that the most consistent, most persistent source of excess returns in the region is actually earnings revisions. It's better than growth, it's better than value. These other factors do work from time to time, but they're also very much hostage to the earnings cycle, or the economic cycle, and therefore the earnings cycle. And therefore you have great periods and also periods of underperformance. This is an ex post analysis. Naturally, it is actually hard to extract these returns from markets, because you have high transaction costs and you also have the time decay of information. So quant funds do try to do this, but struggle because of those transaction costs. The other thing is, it is influenced by macro. And so if you're just in this all the time, you're actually very heavily exposed to macro. And we are actually very much trying to get idiosyncratic risk and sources of returns from the markets rather than just being macro driven. This slide on the right talks to just the opportunity set being quite large if you do this well. The top quintile performers on revisions significantly beat the market returns through time, and the bottom quintile significantly lagged the market returns. So it speaks to the dispersion in the market and the opportunity set as active investors if you can do this well. The other thing that is important to highlight here on revisions is that it's not just a broad factor, it's actually a very specific factor that works within countries and sectors or industries in the region as well. In fact, you have a positive IR to the factor in every single one. So that means we can take a diversified approach and try to extract these returns from the market. And therefore, this is not just a very centric, specific country or specific sector fund, because the factor actually works across the board. Just to shift gears a little bit in terms of risk management, I know risk management is important. I guess even over my 20 years, risk management has been important and deliberate part of what I do. We both have the risk management within the team. We have fantastic tools at Man Group to really understand the risk that you're taking as a portfolio manager, and doing that on an ex-ante basis. So before you trade, we have the technology to understand what would happen to the portfolio. to make sure that the risk that we're taking is deliberate. We also have an oversight function which is separate, which makes sure that I'm operating within the guidelines, the broader guidelines of the mandate. So we take risk management very seriously, both in terms of the day-to-day portfolio management, but also in terms of compliance aspect. This is a typical look at risk management. As I said, this is deliberate. This is not just by chance. This is actually very much an active part of the portfolio. We aim to have at least 65% of our total risk being idiosyncratic risk. Sometimes it's 85%, and it does vary through time, but it is a minimum of 65% risk is idiosyncratic. And this is a traditional Barrow report, which shows you where the portfolio was at this point in time. Again, what we're trying to highlight here is diversified top-down risk, where one decision is not going to really make a huge difference to the portfolio, but again, deliberate in terms of our factor exposures. What we're really trying to do is make most of our risk and most of our return stock-specific risk and return. So if you think about what I've said, what we are trying to do is extract earnings revisions factor from the market, but in a very stock-specific manner. And what we are finding, and what I've found throughout my career, is our portfolio returns tend to be uncorrelated to other factors, because what we are extracting is idiosyncratic risk around a factor that we know that works, being earnings revisions, and therefore our excess returns tend to be uncorrelated with other portfolios and other portfolio managers. But this is what I've been doing for 20 years and can continue to do. As I said, we just try to build a better mousetrap through better introduction of data, including big data, and risk management and technology tools as well. I think the last bit of this is around ESG, and it's certainly become an important factor for investors. But what I find really interesting about ESG is that it now actually becomes a source of returns in Asia for the first time, really in the last couple of years. I think if you go back before 2019, while ESG was an important factor for returns in developed markets, particularly Europe, really hasn't been a source of excess returns in Asia. But now what we are seeing as a source of excess returns, and the simple reason is that policy is starting to change. Now, in many ways, Asia is behind developed markets, but the direction of travel now is positive, and I think it won't reverse. So we're seeing across the board more and more policy changes to drive improvements in various pillars of the ESG, but particularly environment. I think governance has always been an important issue when you're thinking about the region, as it has for developed markets. But I think environment in particular and things like carbon reduction are increasingly becoming policy in the region. And the reason that's important is that you now have financial materiality around ESG issues. And I think that financial materiality will only increase through time. And that creates both opportunity and risk for investors. So we very much embed ESG into our decision making and our thinking. And we do a lot of engagement because I think it's important that companies understand the issues and are planning for it, because as I said, there is financial materiality around this now. And that works really well with our process, which is fundamentally based. So we would spend up to a quarter of our time engaging with companies now on ESG issues, simply because it is becoming a very important issue for companies in terms of their long-term outlook. We do have some slides here around our engagement. Again, we are not engaging just in one particular country or sector. We're doing engagement across the region. And to be honest, it is still early days. Some companies, some countries understand it and are moving in the right direction, and others are not. The way we are looking at this is we want an above average ESG score. We will, however, invest in some low ESG score companies, but only those which we can, through engagement, understand they will improve, and we understand the financial materiality of that cost, of that improvement. But overall, we're looking for above average ESG scores for the portfolio. And this is some of the statistics around our engagement in terms of that ambition. I think this slide around just measuring our ESG impact, I think this is really important as a starting point. The industry is evolving, but it still has a long way to go. And what we are seeing is a bit of a shortfall in some of the ratings agencies in terms of the quality and also quantity of the research. We've come across numerous examples of reports that have been written on companies without any involvement of those companies, and with things which perhaps could have easily been addressed or corrected. So we do our own research. We obviously do look at rating agencies and their research and their scores, but it's really just a starting point. It's important that you understand that the region has still a long way to develop, and it's really important to do your own work rather than just rely on third parties to understand your ESG exposure and risks and opportunities. So just to shift gears a little bit, I think it's important to talk a bit about the outlook. And the reason I want to do that is, I do see myself as someone who tries to be objective about my asset class. In fact, it's been tough as a man group salesman over the last 18 months because I've been very negative about the asset class. At the heart of why I've been negative, I've seen downside to corporate earnings, i.e. negative earnings revisions. And as we saw earlier, that means negative absolute returns for the market. So I've been running very defensive portfolios now for 18 months, and that's worked well. But more recently, we've started to turn actually quite positive, and it's probably the most positive I've been in a couple of years for returns from the asset class. That may seem a little bit strange given the headlines you're seeing, particularly around China and more broadly, asset prices. But I do see this as a great opportunity, and I'll go through exactly why. So there are a number of reasons I think Asia actually looks a little bit different now versus where you would normally see it in a global economic cycle. I think up until this last 12 months, Asia really has just been high beta on the rest of the world. So if global growth is good, Asia's is better. If global growth is bad, Asia's is worse. And so it's really been a beta on global growth, and not just growth, but also things like inflation. What has actually transpired with COVID is that Asia has sort of broken out in terms of its own cycle. Not all of Asia, because some of Asia is actually very much exposed to developed markets, particularly some of the North Asian markets like Korea and Taiwan. And China seems to be on its own cycle, which we'll talk about. But the South Asian markets, places like Philippines, Thailand, Indonesia, and India, these are markets which tend to be bull market bullies and suffer in bear markets globally. But what happened coming out of COVID, and particularly developed markets coming out of COVID, where you saw a lot of stimulus, free money, and a lot of growth, and globally, Asia was actually still stuck in COVID for most of that period. We didn't have vaccines or enough vaccines. We didn't have enough vaccines that worked. So mobility remained restricted in Asia at a time when global growth was booming. And that's really the first time we've seen that. Now, that has meant that on the flip side, as the world is slowing down, we don't have the problems that developed markets has, which we normally would have at this stage of the cycle. So we don't have asset bubbles, we don't have inflation, and we don't have concerns around excesses in general. I think the point on inflation, though, is really important. Asia does not have an inflation problem. Developed markets have an inflation problem. And that inflation problem is leading to much higher interest rates. And that is now starting to restrict growth in developed markets. But again, we do not have the problems in Asia around inflation. So it's really the first time we've seen Asian inflation below developed markets in at least the last 20 years. And I think that's a really interesting setup for next year in particular. As developed market interest rates peak, it means that central banks in the region can start to take control of their own monetary conditions and start to stimulate economies. So I think it's important to understand this is a different period to what we're used to, where the inflation outlook for Asia is actually much better than it is in the rest of the world. Moving on to the next slide, so why is that the case? Well, I think commodity prices are global in nature, and therefore everyone is exposed, with the exception of some policies. But the services side of inflation is really where a lot of the problems have been in developed markets, particularly with COVID reducing workforces for different reasons. That supply side reduction at a time when demand was stimulated has meant that wage growth has been the highest it's been in developed markets for a very long period, which is driving services inflation, which is really what's driving headline CPI. Asia, we do not have that problem. We actually have an excess of labour when the West has a deficit of labour. So you can see here in this slide that the result of that is that there's a very different outcome for inflation. So we are seeing the biggest dispersion or in inflation between developed markets in Asia relative to history. And again, that creates enormous opportunity, I think, for going into next year. This next slide talks around the dollar. I think the number one golden rule around investing in Asia and emerging markets generally historically is you need to have a view on the dollar, to have a view on the direction of the US dollar, that is, to have a view on the direction of the markets. There has been a very strong negative inverse relationship historically between the dollar and Asian markets. So if the dollar is strengthening, Asian markets would normally be very weak, and the opposite of that as well. But I think many people have been concerned with what has been a very strong dollar environment this year, the effect that would have on Asia. And that's the experience of the previous periods where the dollar has strengthened this much in a global slowdown, being 97 and 2013. And you can see there the Asian currencies in those periods suffered dramatically. And that speaks to really what I talked about earlier. Asia historically has been high beta on global issues. But what we are seeing this year, really starting in probably Q2, is the Asian currencies have been much more resilient than what you would normally expect at this stage. And that is a really good setup. It means that central banks are taking control of their currencies. They're not impacted by what's going on in developed markets. And therefore the setup is very different to previous cycles. So as developed markets interest peak at some point soon, and therefore the dollar hopefully peaks, US dollar hopefully peaks, we think you'll start to actually add accelerant to the growth that is already recovering, particularly in South Asia, going into next year. So more growth coming for the region on top of existing recovery trades from coming out of COVID. Now, shifting to China. China is a big market. It's been through an incredibly difficult period. I think the biggest challenge that China has had has been COVID and their approach to COVID. The reality is the vaccines that China has employed are not as effective as Western solutions, and they're unlikely to use Western solutions. And number two, because they've had a COVID zero policy, it's actually been quite difficult to get the entire population vaccinated, particularly the older population. And we've known these issues now for some time and have really believed that China was going to continue the COVID zero strategy and the detrimental effects that has on the economy until they found a solution. The good news is we do think they've found solutions now, and we do think they're moving quite quickly to removing COVID zero. And the outlook for next year, I'm not sure exactly the timing on this, but I do think the outlook for next year is one of increased mobility as COVID restrictions are removed in China. They do have some very good drugs, we think, in the pipeline that will allow them to boost coverage within the population in the coming months, and that will allow increased mobility and growth. But I think what's important to understand about China, and moving on to some of the sort of more structural issues now, is the recovery in China is not going to be the playbook you've seen in developed markets. For a number of reasons. There are some structural headwinds to the Chinese economy, particularly consumption, where you're faced with a slowing property market and high levels of debt. But also, the response to COVID was different in China to the West, in that in the West, people were paid to stay at home. And as a result, because there wasn't a lot to consume, savings were built up. And so as mobility came back in the West, consumption boomed. China has not taken that approach. There's been no support for the income. The support has come at the corporate level to try and keep unemployment contained, which hasn't worked particularly well. And as a result, household income has been very weak, and household savings have been under pressure. So as mobility increases, we do not think this is as I said, a developed market like consumption boom. We think it creates stability in the economy, and there will be pockets of growth. But I think this slide here shows you why there's a challenge. Firstly, on the right-hand side, you have very high private sector leverage in China. In fact, it's higher than in the US, which is a long-term problem. And the government is fully aware that they need to focus on deleveraging rather than releveraging. And on the left-hand side, you'll see there that historically people have liked to play China as its credit multiplier shifted. We just don't think you're going to see the same response you saw in 2011-12 coming out of the global financial crisis, or even 2015-16 coming out of the deflation scare, in that we don't think debt is the solution in China. There's already too much of it, and the authorities understand that. Property space is our next slide, and that is really, there is one thing you need to understand about the property sector. The leadership has decided that it's for living and not for speculation or investment. There's been a lot of investment and speculation in the property market historically, and that is all unwinding. So we're seeing incredibly weak property market and don't expect that to change anytime soon. We're seeing some developments to ensure that the existing pipeline, the existing projects are being completed, liquidity is being given to the developers to make sure that happens, but don't expect a new cycle. And this has historically been up to about a third of the economy, and it's not going to recover. So again, a big headwind for long-term growth, and another reason why consumption will maybe recover but be fairly muted in its recovery. So in terms of our exposure to China, we've been very negative. The Chinese market has underperformed until around March. I think the thing about when you're investing in China is really trying to understand policy, because it does have a big influence in a command economy in terms of what growth looks like and where growth comes from. The shift here you'll see in our portfolios in March was really when we finally started to see authorities and policymakers understand the enormous challenges and now lend to being supportive rather than restrictive. And that's when the market bottomed. We've had some volatility since then, but we do think that China now has bottomed because the policy is going to be much more supportive, particularly with COVID, coming out of COVID. So we have moved from underweight to overweight position in China. Elsewhere in the region, the developed markets are exposed. Economies like Korea and Taiwan, I think, remain challenged until we get on top of the tightening cycle in places like the US and the West generally. And therefore, sectors like technology, which have actually overearned during COVID as people worked from home, and the stimulus in terms of things like PC demand that came from that, I think there's still a long way for that to unwind. So we still remain negative until we get more positive around developed market growth in general, as policymakers get on top of inflation. Same for Korea. You can see here it's very exposed to global growth. The market earnings through its export stocks, which are a large part of the market, and therefore the market itself. South Asia is definitely an area that we're positive on. It's had actually a very good year. Places like Indonesia have done extremely well finally coming out of COVID, but they've also seen been beneficiaries of the commodity boom that's gone on. And so the stock market is seeing positive revisions and positive growth, and it's improving. And we do think that continues. In fact, as I said, with hopefully the dollar peaking, and I think you'll start to see capital start to flow into these markets, and that'll add accelerant to the current growth outlook. So I think the outlook for these smaller economies is actually very strong going into next year, as it has been this year. One of the reasons for this space is that the Southeast Asian economies don't have the debt problems that North Asia and developed markets have. In fact, household debt to GDP is even a third, maybe a quarter of the levels of developed markets. So as you get lower interest rates and you've got inflation under control, you get stimulus coming through. These are the markets which I think look particularly attractive, short, medium and long term in the region. Moving on to the next slide here in terms of absolute and relative growth differentials, I think this is really one of the most important things around if you're thinking about investing in the region. The great mistake I see consistently and still today is that people come to Asia because it's high growth. Asia has been high growth and higher growth than the rest of the world over the last 10 years, yet it's still underperformed developed markets over that entire time frame. What is most important is not absolute growth, but two things. One is the change in the level of growth, and number two, the relative growth between Asia and the rest of the world. Positive revisions to growth deliver positive returns to the market, but expansion of growth versus developed markets, particularly the US, gives you better relative returns for Asia. And you can see there's been really two giant cycles here for the market. And that has been during the 2000s when global growth was good, but Asia's growth was accelerating both relative to its previous years, but also relative to the US, and therefore you saw Asian markets outperform the US. And the last 10 years, you've seen Asian growth be fairly stable or declining slowly at a time when developed markets were stable or improving. And as a result, growth differentials, collapsed. And as a result, Asia underperformed. So this is not a market you simply have to have exposure to because it's high growth. You want exposure to this market when growth is better than the rest of the world or when it's improving relative to where it's been. Because that's what really drives both absolute and relative earnings revisions within the region. And the outlook for next year is one I do think where developed markets continue to slow down while Asia starts to improve because of the story in Southeast Asia, because of peaking interest rates without the inflation problem, and also now China coming out of COVID and the benefits that come from that. So for the first time, we may actually see Asia's growth relative to the rest of the world expand and absolute growth improve as well. And we're starting to see some evidence of that in the relative performance this year. As I said, this has been a very different cycle. South Asia's done well in a strong dollar environment, and we're seeing Asia as a whole perform better than what you would normally expect at this stage in the dollar cycle. But within that, you've actually seen South Asia do extremely well with positive returns in what has been a negative return environment. So really to summarize, I have been negative on the region. I'm now positive. The reason I'm positive is we're going to see the benefits of not having inflation pressures start to emerge next year. We don't have the structural problems that the West has, which is driving inflation, particularly labour. We have excess labour when the rest of the world has a scarcity of labour, and that's been an inflationary problem and therefore an interest rate problem. Secondly, we don't have speculation. We didn't get the benefits of strong growth that would normally drive speculation and asset bubbles. We haven't had those because of mobility restrictions and therefore lower rates of growth. And the region therefore has been unattractive until recently. But that lack of speculation is actually now positive as you move into next year. Thirdly, we are seeing a policy pivot in China, not in terms of financial or credit, but more importantly in terms of COVID policy and the benefits that come from that. We think China is moving into a more stable economic environment with pockets of growth. This is not a DM playbook. It is very China specific because of the way COVID impacted China, but we do think it's going to be a better outlook. I think the structural reform is definitely an element where parts of our portfolio are exposed. There are parts of Asia that do benefit from structural trends. You do need to be careful with structural thematics because a lot of them don't translate into corporate profit growth, these structural themes. But where you can find structural growth, GDP plus type businesses that are fundamental or profits grow above GDP, they tend to be quite attractive. They're just harder to find, but when you can find them, they tend to be quite lucrative, and we're seeing some opportunity around that. And then really just this story around domestic demand picking up when the rest of the world is slowing down, and that will drive improving earnings revisions, having seen a downgrade cycle that's lasted a couple of years, which probably means that markets have now bottomed and the outlook for 2023 is strong.